Hi everybody, on 20th January 2020, the Indian stock market made a record intraday high. The Sensex touched 42,273. Then on 12th March 2020, the market saw one of its biggest falls. The Sensex dropped 32,778 after the coronavirus was declared a global pandemic. The very next day, on 13th March 2020, the market hit the lower circuit in the morning. Trading was stopped for a short time and the Sensex crashed further to 29,687. Then came 23rd March 2020. That day, the market saw one of the worst single-day falls in the Indian history. The Sensex touched 25,638 as the government announced a nationwide lockdown and shut stores and factories. So in just 2 months, the market lost around 40% of its value. It was one of the fastest and sharpest falls in the Indian market history. Millions of retail and institutional investors saw large losses on paper. But the story did not end there. After almost 9 months, on 9th November 2020, the market made a new all-time high. The Sensex touched 42,597. Then on 20th January 2021, the Sensex closed at 49,792. So within 1 year, the market first fell by 40% and then recovered strongly, even moving above its earlier high. A lot happened during this period. On one side, many investors lost lakhs and crores of rupees during the fall. Money Control reported that crash reduced the value of LIC's equity holdings by 27.6% from 5.5 lakh crore rupees on 22nd Feb 2020 to 4.01 lakh crore rupees on 20th March 2020. On 23rd April 2020, Franklin Templeton, a mutual fund house in India, said it would shut down 6 debt schemes because of illiquidity caused by the pandemic. But on the other side, many investors also made money when the market recovered. The Economic Times reported that 22 out of 39 stocks in Rakesh Jhunjhunwala's portfolio had more than doubled after the COVID year. Mint also shared a story of a law student who learned investing during the lockdown and invested a small amount from his internship stipend. As the market recovered, his portfolio doubled and he used the profit as a down payment for a two-wheeler and a laptop. But the real question is, why are the markets so volatile? Why do some people lose money while others make money? And what we as an investor can learn from this? Think of this. You are walking through a jungle. Suddenly you hear a sound in the bushes nearby. What would you do? Would you calmly stop and think, or would you run assuming there is a danger? Most people would run away. This is called survival instinct bias, specifically negativity bias. In certain situations, our mind focuses on the danger than on the calm reasoning. We give more importance to the safety than to the neutral or positive signals. So we react first and then think later. Something very similar happened during COVID. The news of global pandemic created huge uncertainty. People started thinking only about the negative side. They worried about the economy, they worried about the business losses, they worried about what could go wrong next. As a result, many participants panicked and sold their holdings. This is the first phase of market crash. Fear takes control and people want to get out at any price. Then comes the second phase. When others see prices falling, they think something must be seriously wrong, so they also sell. This is called social proof bias or herd mentality. As more people sell, the market falls even more. That is how a sharp collapse happens. But market crashes do not last forever. The important point is that such falls are usually temporary. Corporate earnings may go down in the short term, but over time they will recover. As the effect of pandemic started fading away, business activity became normal again. As earnings improved, the market started moving up. Now look at what happens to the people in this process. Those people who sell in panic during the fall often lock in their losses. They sell because they fear that if the market falls more, they will lose even more money. But many times they forget one simple thing, that the fall may be temporary. And those who buy during the deep fear often benefit when the market recovers. This is what happened during the COVID crash, and this is what happens in most major market falls. This gives us three important lessons. Lesson number 1. Markets move in cycles. This is true not only in stock market but in almost every market where humans are involved. From tulip mania in 17th century to commodity booms and busts to real estate cycles, the same pattern keeps repeating. Optimism first pushes the prices too high, fear then pulls them too low. So, an investor should not be surprised by the cycles. He should expect them, prepare for them, and use them in his advantage. Lesson number 2. Extreme situations do not last forever. When prices fall too far below their intrinsic value, they often recover. When prices rise too far above it, they will eventually cool down over time. The same idea applies to earnings, profit margins, interest rates, commodity prices, and even investor sentiment. So never assume that today's extreme condition will continue forever. And finally, lesson number 3. Temperament matters more than intelligence. Many investors know in theory that markets move in cycle, but in real life, fear and greed takes over. When prices rise, people become overconfident and chase returns. When prices fall, they panic and sell at the worst time. So the real edge in investing does not come only from the being smart, it comes from staying calm and acting with discipline. And finally, to end this video, call to action is simple. Prepare yourself before the cycle turns. Keep liquidity, study the value of the business, strengthen your temperament. One practical way to do that is to build a rules-based system. Write down why you are buying a stock and write down the reasons for which you will sell it. When the market enters the fear, rules will protect you better than the emotions. And that was it for this video, and I hope this video provided some value to you. If you think this video provided some value, please like this video and subscribe to this channel. Thank you so much for watching. I will see you in the next video.